I welcome you all to the 1Q FY2024 earnings call for Tarsons products. From the management team today, we have Mr. Rohan Sehgal, Full-Time Director, and Mr. Santosh Agarwal, Chief Financial Officer. I will now hand over the call to the management team for the opening remarks, post which we can start the Q&A session. Thank you, and over to you, Rohan.
Good afternoon and a very warm welcome to everyone present on the Q1 FY24 earnings conference call for Tarsons Products Limited. Along with me today, I'm joined by Mr. Santosh Agarwal, the Chief Financial Officer and the Company Secretary, and SGA, our Investor Relation Advisors. We have uploaded our quarterly investor presentation on the stock exchanges and company's website. I hope all of you had an opportunity to go through the same. Let me begin by offering some background information about the industry. Currently, the life science sector is experiencing a slowdown leading to a notable reduction in demand for plastic laboratory wear products, both in the international and domestic market. As a result of this deceleration and weakened demand, the overall industry has contracted, shrinking by over 15%. However, our revenues for this quarter have seen a 9% decrease. It is important to note that while our revenue appears to have declined by 9%, we have been exceeding industry trends and enhancing our market position compared to our peers. Another contributing factor to the decline in this in the revenue is the high level of inventory which is there in the distribution channel. Looking ahead, we hold an optimistic view regarding an industry resurgence and the normalization of channel inventory levels, which should pave the way for a revival in growth. Let me speak about the inorganic growth opportunity. Our strategic vision is firmly fixated on a significant growth potential that the export market holds for us. To harness this potential, our approach involves the acquisition of a brand or a distribution channel, a move aimed at establishing a strong presence in the overseas market. The basis of our strategy involves an inorganic opportunity that fosters the strengthening of our channel and distribution partnerships. This pursuit primarily revolves around the acquisition of brands, channel partners, large distributors, allowing us to fortify our network and extend our market influence. Our strategic scope extends beyond channel enhancement, encompassing a comprehensive exploration of various acquisition prospects. This comprehensive approach underscores our commitment to diversification as we seek opportunities that align with our strategic objectives and resonate with our growth aspirations. While we embark on this trajectory of seizing inorganic opportunities, we recognize that there will be associated costs. These costs are an integral part of this process, embodying the investments required to actualize our expansion objectives and enhance the diverse range of our business pursuits. We are in active process of evaluating such acquisitions, a strategic move aimed at bolstering our global footprint and expediting our journey towards accelerated growth. On the EBITDA front, the reported EBITDA margin for Q1 FY24 was at 34% during the quarter. This decline was due to the lower absorption of fixed expenses due to decline in revenues affecting margins. We have also allocated increased resources towards new product development and bolstering our marketing efforts for our plan to manufacture new products by expanding our capacities. While this proactive approach lays the groundwork for future growth, it has momentarily contributed to higher operation costs. In line with our growth strategy, we are gearing up for capacity expansion and establishment of new manufacturing units. This forward-looking investment necessitates increased spending in the short term, which will generate higher revenue going forward. Our EBITDA was also impacted on account of a one-time expense of rupees 2.8 crore, which was incurred for the due diligence charges associated with the potential inorganic opportunity. Regrettably, this opportunity did not fructify due to a valuation mismatch. After adjustments for the impact of this one-time item, our adjusted EBITDA is 24.1 crore with margins of 38.5%. On the capex front, first on the Panchla facility. Panchla is introducing cell culture and increasing capacity in existing products. Civil construction has been completed and our first clean room is completely ready. We are, however, awaiting certain machines that are already in transit. We anticipate that the first round of production will begin in Q3 FY24. Furthermore, cell culture and other products are expected to begin commercial production in Q4 FY24 and Q1 FY25 in a phased manner. In the second plant, which is the Amta plant, we are building a radiation plant and have signed a memorandum of understanding with the Board of Radiation and Isotope Technology BRIT to do so. This will reduce our dependency on a sole vendor in our local region. We are also building a central warehouse operation which is currently under construction. We are shifting our bioprocess manufacturing from a rented facility to this facility in the coming months. This will have higher operational efficiencies going forward. Before handing over the call to Santosh, I'd like to state that in the short term, things appear to be difficult due to the macro environment, which has clearly impacted most of the laboratory players in the industry. However, we are confident in our strategies to take Tarsons at high levels. With our expansion and new products as well as acquisition opportunities, we are poised for a bright future. With this, I would like to hand over the call to Mr. Santosh Agarwal, CFO for Tarsons, for his comments on the financial highlights.
Good afternoon, everyone, and a very warm welcome. Let me take you through the financial highlights for Q1 FY24. On the revenue front, revenue from operation for Q1 FY24 stood at 63 crore as compared to 69 crore in Q1 FY23, lower by 9% on YOY basis. However, the overall industry and other organized players had seen a dip of more than 15%. For Q1 FY24, revenue from export stood at 17 crore rupees and domestic revenue stood at 45 crore. For Q1 FY24, export sales contributed around 27% and domestic sales contributed around 73%. At the gross profit level, our gross profit for Q1 FY24 stood at 47 crore as compared to 54 crore in Q1 FY23. Our GP margin for Q1 FY24 stood at 75.1%. On EBITDA front, our adjusted EBITDA for Q1 FY24 stood at 24.1 crore with adjusted EBITDA margin of 38.5%. This has been adjusted for 2.8 crore one-off expenses on account of due diligence charges for a potential inorganic opportunity. Our reported EBITDA for Q1 FY24 stood at 21.3 crore as against 31.1 crore in Q1 FY23. Reported EBITDA margin for Q1 FY24 stood at 34%. At a PAT level, profit after tax for Q1 FY24 was 9.6 crore with PAT margin of 15.3%. With this, I would like to open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Our first question is from the line of Omkar Kamtekar from Bonanza Portfolio. Please go ahead.
Hello, thank you for the opportunity. First question is, so there has been an increase in the employee expenses. So is this normal in line with the...
Mr. Omkar, may we request you to use your handset, please?
Okay. Is it better now?
Yes, sir. Please go ahead.
Okay. So, firstly, there is an increase in the employee expense. So, this is the normal annual increase in the employee expense, or there has been some additional employees being employed for the new plants and etc. Is it the clarification on that?
So the increase in the employees is majorly the annual increase in the employees year-on-year compensation increase for approximately 650 odd employees. However, there have been some new hires and very little contribution has come in the first quarter because many of them have joined over the last 8 to 10 weeks. So moving forward, we would see some increase in employee expenses for the new hires, which would show completely in the full quarter. There could be 1 month, which is the third month of the first quarter, which must have seen certain new hire employee expenses.
Okay. So we can expect the employee expense to increase a bit further in the coming quarters. That would be fair.
Could be, but these employees are being hired for the newer facilities for newer product lines, which for us is expected to increase revenues. So
okay.
Overall, in the long term, I don't see the employee percentage to the revenue moving drastically from where it is today. It should be in the same range.
Got it. And sir, with respect to the acquisition, the one that was not able to fructify, so could you, is it possible for you to give us a range of what was the proposed mismatch in the valuation? So like, what was the deal value that you were proposing, and what was the counterparty demand? Would that be disclosable?
Yeah. So I think we were one of the front runners in the acquisition, and the valuation posed by us was among the top 2-3 valuations. However, based on the final due diligence and a lot of other activities, as you see, revenues are dropping. Worldwide revenues are dropping for a lot of companies because of reduced demand. So the person who actually acquired the company and won the bid did not re-rate the number which was originally given. We went ahead and re-rated the number because earnings and revenue had fallen for the proposed acquisition. So the variance was approximately 20 to 25%. That's all I could mention.
Okay, so you will not be able to give the number? I'm just
no, that won't work.
Sir, we have signed a non-disclosure agreement with the potential target, so we cannot disclose the numbers.
Fine. And just finally a follow-up on that, are there any other acquisitions in line, parties that are identified for inorganic acquisitions?
So we have certain agencies who are working for us, looking at potential targets, and as and when you find suitable targets, we will move ahead to the next stage to explore further.
Okay.
But this is an active work which is going on continuously at the company.
Okay. I'll get back into the queue for the follow-ups. Thank you.
Thank you.
Thank you. Our next question is from the line of Jasdeep Walia from Clockwine Capital. Please go ahead.
Hello. Am I audible? Hello?
Yes, you are.
Yes, sir. Please go ahead.
Yes. So thanks for taking my question. So how did you see demand trends during the first quarter across various segments? And how are you seeing those trends incrementally?
So the demand in the first quarter has been relatively lower for the consumable segment as compared to the other segments. Understandably so, because there is a large overstock and an overhang from COVID, because 95% of the plastic used during COVID was consumables. So we see, a lot of demand reduction in the consumable space. The other sectors, which is the reusable plastics and the instrumentation sector, is relatively lower affected as compared to the consumable sector.
Got it. And sir, can you also talk about the demand across segments like diagnostics, pharma, research?
So at this point of time, as I said in our earlier calls, I think the diagnostic and the research and the pharma segment relatively remains, in lower requirement for plastics as compared to previous quarters in COVID as well as the pre-COVID quarters, which led up to COVID. The biotech and the CRO segment continue to perform very, very well, and the other sectors, specifically in India, continue to underperform. I still feel that although if you look at our revenue concentration of 73% and 27%, I still feel that the pressure in the Asian subcontinent is much higher than the European and American subcontinent. Of course, our stronger position in Asia will be able to generate more revenues, but Asia at this point of time seems to be having a tougher time recuperating as compared to Europe and US. Although the entire world is going through a very, very sluggish phase in the plastic labware market.
Got it. And sir, across these various segments, are you seeing signs of recovery for any of the segments, or broadly all segments are showing similar trends continuing?
So, see, an issue is that there is huge inventory levels at the customer end as well compared to the distributor end. So certain large customers have also panic ordered so much of inventory which they are slowly moving out and slowly clearing out. So recovery levels were there, which was there in the Q4 levels. We did much better compared to the previous 3 quarters, but that had a lot of effects of customers wanting to complete their targets, salespeople wanting to complete their targets, distributors wanting to complete their targets, as well as a strong push, brand push from our side as well in the domestic market. But recovery levels are there, but they are very slow. I do not see a complete recovery, in this quarter as we're talking, which is Q2. But recovery in the domestic and international market is not as strong as what we had expected for Q2.
Got it. And so on the competition front, are you seeing pricing pressure in the market, or your view on that front remain the same as in the previous quarters?
I can hear your question, please. Could you repeat it?
So on the competition front, are you seeing incremental pricing pressure in the market because there's a lot of capacity which is hello? Sir, on the competition front, are you seeing incremental pressure on pricing because a lot of capacity has come in, particularly in China? Is that leading to lower realizations in some of the segments?
So there is I think it's not only China, but it's globally that there has been a lot of capacity. So globally, the market has become competitive. We don't see a lot of lower realizations, as you can see from our material margins remain pretty much intact to where it was. But yes, there is a global competitive pressure which seems slightly temporary, as there was a involvement of a lot of new players over the last 2 to 3 years. But we see players retracting back as well, as the industry does not pose the kind of lucrativeness it posted during COVID for the new players.
Got it, sir. So my last question, sir. Sir, how much of cell culture products are exported by Chinese companies, and what is it as a percentage of global production of cell culture products?
I won't have identical numbers for you, at this point of time, but I think China would export close to $70 to $80 million of cell culture products, just purely cell culture consumables, out to the rest of the world. And I won't know what percentage that would be of the total volume, but it would be a very insignificant or small percentage. Cell culture is still primarily dominated by Europe and the US.
Okay. Got it, sir. So thanks, sir. That's all from my side.
Thank you.
Thank you. Before we take the next question, a reminder to all participants that you may press star and 1 to ask a question. Our next question is from the line of Jaiveer Shekhawat from Ambit Capital. Please go ahead, sir.
Sure. Thanks a lot. Rohan, my first question is in relation to how you think about your acquisition strategy. Given this quarter, you've almost spent about 5% of your top line on due diligence of an acquisition which will materialize. And how do you think about, say, further acquisitions down the line? Would you be looking to still spend that substantial amount on the acquisitions?
Jaiveer, could you just repeat the question? Your voice is not coming in properly.
Can you hear me now?
Yeah.
I was trying to understand about your acquisition strategy, given this quarter you've almost spent 5% of your top line on a due diligence of an acquisition which couldn't materialize. So your thoughts there?
Right. So See, the thing is, we spent approximately 2.8 crores, on the acquisition due diligence, which would have been no different had the acquisition gone through. Unfortunately, the times are very volatile at this point of time. As you see, our revenues have not shown up, and you can imagine certain companies where an acquisition process is not an overnight process. It is about 6 to 8 months, and by the time you sign an agreement with the party to move ahead and give an offer and bid, which gets accepted, and start the due diligence and complete the due diligence, it's approximately 4 to 6 months. And in 4 to 6 months in this volatile industry, you've seen numbers totally disintegrate. And what was shown to us and what actually was the due diligence number based on 6 months of degrowing revenue, things look very different. So we thought prudently that at that point of time we had to discount the number which was originally given because of the lower numbers and the lower earnings. However, some of the competitors who bid in decided to stick with the original number and they won the bid. So we would stick to this strategy moving forward as well. I feel this is a good time because the industry is slowing down and we could come across some good companies at very, very attractive valuations to acquire. But in this process, we might end up spending, some one-off expenses, which I think would be worth it if we are able to find the right company.
Rohan, related to this is in terms of your exports revenue. So what we have seen is when we compare Tarsons' export revenue to the overall market potential, it's quite negligible. And if I see your export revenue trend, it has been largely flattish or declining over the last 2.5, 3 years, despite the wide range of products that you have. So could you highlight on the challenges that you're facing on this front, and why are you not able to increase your wallet share with large multi-million-dollar enterprises that you deal business with, despite the fact that your unlisted peers, they have found avenues to multiply their scale of business?
Right. So if you look at our international revenue, it constantly grew right up to FY22. We saw a slight decline in FY23 from FY22. So that was the first year of international decline, what we saw in the international markets. Apart from that, from 2010 to 2022, we've constantly grown. Now, at this point of time, we have strong relationships with large catalog companies and other large importers all over the world. But it is, as I explained, it's a time where people have large amounts of inventory and unsold inventory. And it is not a time when they would like to bring in new inventory or bring in new relationships, or with our existing relationships, bring in new product categories. So we would wait for the market to actually stabilize and inventories from channels start reducing before they start looking at newer opportunities. At this point of time, as I do not have any numbers of any unlisted peers, it's not available. We do not see any growth or even flat revenue of any of the unlisted players in the international market. It's all in a declining trend from 23 onwards. Still 22, everybody grew and so did we. But the story post-22 has been very similar of the industry of what our story is. There's no difference as per our understanding.
And Rohan, lastly, my question is regarding the commentary that you have been giving around demand outlook. So if I just go a quarter back, in your fourth quarter earnings call, as well as in the investor presentation, you were highlighting about the demand pickup and the early signs of arrival in the industry. And even if I go, say, first quarter and second quarter of the last year, you were also alluding to the fact that your conventional business was growing, which is except COVID business, possibly in 20-25% on a year-on-year basis. Now, this quarter, we have seen, despite no COVID-related revenues in the base, your conventional business also declined. So I'm just trying to resolve this entire mismatch, and why is it that the outlook for the industry is changing so in a very volatile fashion, especially on a quarter-to-quarter basis? And second is in terms of your confidence to really ramp up your revenues post your Panchla commissioning, or would it be possible that you might end the year on a flattish note itself?
Sure. So if you see, we ended FY22 with our best performance ever in the history of the company, and FY22 was March 22. So post March 22, we had a large influx of orders which we could not suffice. And a lot of that over-ordering which was there, or back orders, what we would call, was sufficed through the next 3 to 4 months post March 22, which we did not have enough capacities to give in. So while we did not have any new ordering throughout, April, May, June of last year, our new orders this year are much better than our new orders last year. But we did not have the backing of a large COVID year behind us this year. And hence, you will see lower revenues. You know, the picture looks very different. The story looks very different because it shows lower revenues as compared to last year. But we were coming off a quarter which was the best ever quarter in the history of the company and a best ever year in the history of the company, which we are not coming off this year. So primarily, that is the main difference between last year and this year. And if you look at orders received or fresh orders received, I think the first 5.5 months, as we speak today on 14th of August, the fresh orders received domestically and internationally are much stronger than last year's fresh orders received.
Understood. So in terms of your outlook for the rest of the year, do you believe are you likely to end the year on a flattish note, or would you be able to at least increase your revenues post the Pasla commissioning?
So at this point of time, we still believe we can increase our revenues compared to last year, but we will move ahead and see how the industry reacts and performs over the next 3 quarters. As you see, the industry trends have been very, very volatile. We did extremely well in the previous quarter, which was Q4, and then Q1 has again come down. But it's very similar to whatever available data is there in the industry from global peers. If you look at their Q1 numbers, it was much stronger, and Q2 numbers have declined because most of the international companies work on Jan to December. So their Q1 was stronger in a recovery, and then Q2 again came down.
Sure. Thanks a lot.
Thank you.
Thank you. Our next question is from the line of Amar Maurya from Alpha Accurate Advisors. Please go ahead.
Thanks a lot for the opportunity. So firstly, sir, just to understand more on the demand perspective, as you said that, the destocking is the core issue at the export business. So, I mean, how long do we see that, this destocking issue is going to fade? Is it going to take 2 quarters more, 3 quarters more?
I can give you the information what I understand and know from the industry. If you look at larger global MNC multinational players, they also give a very qualitative statement, not a quantitative at the time. They say it's a temporary phenomenon and recovery expected soon. If you read the top 3-4 multinational companies with market cap more than $100 billion, that's what they say. So it's very difficult to predict the global environment at this point of time. And if I tell you next quarter or 2 quarters, I may be completely wrong because I do not have the information myself. I can only speak for how the industry is moving at this point of time. And at this point of time, we see a sluggishness and we do not see a lot of recovery at this point of time.
So I was trying to understand more from the client perspective. A lot of your clients are large global clients and you have a strong relationship from last 5-7 years. So any color, from your client perspective that, that this is going to over, let's say in 1 quarter, 2 quarter. I was trying to understand from the client specific thing because our share in the global pie is insignificant today.
Correct. But as I said in my earlier question as well, the percentage of what we have among the global pie at this point is not important because the prospective customers who could be our customers in the future are grappling with their own problems to add another new problem of looking at a new supplier at this point of time. They have their own problems of overstocking and large inventories. So it would only be opportune for us to engage with them at times when, it would add value. At this point of time, they have to look at their inventory levels which have been stocked up over the last 1.5 to 2.5 years and get rid of those inventories before they can engage into something which is, alternative supplier, better margins for them, lower prices for them and so on.
And one thing to add on that, on year-on-year basis, we are down by 8 to 9%. And in this process, our sales have grown, but we have not lost any of the customers.
So, the demand is buoyant now or any...
Sorry, Mr. Amar, you are not audible there. Could you please repeat your question?
I'm saying, what is the color for the domestic business at this point of time? What is the outlook there?
So the outlook looks sluggish, as I explained earlier, and we do not see any immediate complete recovery at this point of time in the domestic business.
Okay, but then you are confident about a full year growth despite all this, muted outlook. So what is behind that?
Behind that is, as I explained in my earlier question, we see better inflow of orders, fresh orders as compared to last year, but not where we expect it to be. But order inflow is much better than what we had last year. Of course, we do not have a large pending order book what we had last year in the first few months, but the fresh order inflow is much better.
And in our kind of industry, Q2, Q3 and Q4 is always better than Q1. So it is very difficult to judge the full year on the basis of Q1.
Okay. And order book growth on a year-over-year basis would be how much in this quarter?
Approximately 4 to 5%.
Okay. Got that, sir. Thank you.
Thank you. Our next question is from the line of Ranveer Singh from Nuvama. Please go ahead, sir.
Hello. Yeah, thanks for taking my question. Sir, a few questions, I think a couple of things have already been clarified. But still, when we say slowdown in life science industry, despite we see in this quarter most of segment in life science like pharmaceuticals or even the R&D based players, hospitals all have shown very good numbers. I can, for export market, there may be some volatility, but at least in India market, domestic market, the other indicators are showing, most of indicators are showing that there has been a growth. Also, in Q4, we had a very good number. If de-stocking is the reason, then how come from Q4 to Q1 that de-stocking, region cropped up? Because now it's 1 year, more than 1 year, the COVID-related things has vanished. So where is the disconnect or the business model? Probably I'm not able to understand that why the demand has actually gone down in this quarter.
Sure. So, as you said, the hospitals and some of the life science companies must have done very well in Q1 of FY24 in India. However, the sourcing of these companies for plastic labware has come down, and all we are related to as a company is how much of plastic labware does a particular company buy and what can we contribute to that share. So that sourcing bit of plastic labware, that purchase of plastic labware is down, and hence, our numbers are down. And regarding the destocking and how Q4 was high and then Q1 is further lower. If you look carefully, our Q4 was also a slight degrowth. I would say almost flattish as compared to Q4 of last year. It was still a degrowth of about 1.5 crores, right? So the industry was not in the best place because we did not show a year-on-year quarter growth between Q4 of the last year and the Q4 before that year of a huge growth. In fact, it was a 1.5 crore rupee decline. So generally Q4 is a very strong year in India because people look to complete their budgets in purchases, distributors look to complete their targets, sales people look to complete their targets. So it's a large quarter. It's not equally divided between 4 quarters. It's heavily, I would say 35% of the business comes in one quarter compared to 25% equally divided. So that's what we experienced. And internationally, as well as I explained in my last question, was that companies have shown a better performance in Q1. And then again, the performance has slipped a little bit in Q2, and they have not shown that, they have not been able to continue the momentum into Q2. And we've been no different because we only have international peers, listed peers to look at comparisons with. There is no other domestic listed there.
And if you see our Q1 figures, our domestic revenue reduced from 48 to 45 and export reduced from 20 to 17. So the growth came mostly from the export market, not from the domestic market.
Yes, so last year it was 30%, nearly 30% was the export contribution in Q1 FY23. That has come down to 27%, right? So 3% contribution has come down. So this is anyway not a big part of business. And the overall business actually, the domestic being a, major part. So that portion actually wanted explanation. But anyway, secondly, sir, on the next thing, what I wanted, that in Panchala plant, earlier that was supposed to come in August 23, now it shows Q4. So are we going to capitalize this plant in this year itself, or that may go to next year also?
Sir, we will capitalize all the machinery and plant in a proportional way as it goes for the put to use. For example, first clean room will be ready by Q3. So once the production will be started, we will capitalize that portion only. So, and the cell culture will be capitalized by Q4 or Q1 FY25, as soon as the production will be started.
Basically, the entire capitalization will not happen in one go. As and when the machine will be put to use, that quantity would be capitalized.
And when that machine will be put to use?
So we expect commercial production to start in Q3, beginning of Q3 of this year, and we expect machines to enter in the next few weeks, which is 3 to 4 weeks. But commercial production will take at least 6 to 7 weeks after they enter the facility. So the moment commercial production starts, it will be capitalized.
But you have to capitalize on a fully basis, no? Partially, because even if we start production for a small amount, is there any provision that we can do partial capitalization, or because I think this is an integrated facility? So I don't know.
We have about 25-30 machines coming, but all 30 will not come together. So if 3 will come, we will capitalize 3. If 6 will come, we'll capitalize 6. And as and when the numbers will come, we'll capitalize. We cannot capitalize for things which have not come before they come and before they start commercial production. So it's not one machine making one kind of product. It's multiple machines making multiple products.
Okay. And how much capex we have spent so far, and how much is remaining here?
Sir, out of the total capex, we already incurred about 430 crores.
And some part remains there?
Yes, some part is remaining there. About 120 to 150 crores is still pending.
So total would be some 525-30 crore.
Yes.
Okay. And about Amta plant, what is the status there? This is already where we have reached in terms of commercialization or production there.
So the construction is on in full swing. We expect to receive the nod from the government board for radiation isotopes in the next 4 to 6 weeks. So we expect before 30th September to receive the license to operate a radiation plant. And we expect the facility to be fully completed before the end of the year, which is around December 2023 calendar year. And post that, we should immediately move into, so either end of December or beginning of January, the facility should be put to use in terms of the warehousing and the radiation bit. And in terms of the production bit, it would take another 4 to 6 weeks as we are operating out of a rented facility, and that movement from the rented facility to Amta would be a 4 to 6 week procedure, and that can only happen when the facility is fully ready.
Thank you. Sorry to interrupt, Mr. Ranveer Singh. May we request you to rejoin the question queue for follow-up questions, as there are several participants waiting for their turn. Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. Before we take the next question, a reminder to all participants that you may press star and 1 to ask a question. Our next question is from the line of Sambit Kumar from who's an investor. Please go ahead.
Yeah. Thank you, sir, for this opportunity. Currently, we are trading the cell culture equipment. So, what percentage of it is contributing to the top line?
So, at this point of time, we do not know how much would the total top line be as the cell culture product portfolio matures over the next 3 to 4 years. But we expect cell culture business to at full capacities to peak out closer to the 100 crore rupee revenue.
Okay. So how much time it will take to reach that 100 crore revenue?
I expect 3 to 4 years after installation of capacity and commercial production.
Okay. Are you taking any steps, are you taking any steps for ramping up this revenue contribution from cell culture?
So at this point of time, we are initiating marketing activities and making people aware of what we are building and what we are going to be coming out with. But at the end of the day, nobody is convinced unless they feel the product in their hand and actually test the product. And if the product works well according to their research or according to their production, then only they would be committed to buy from us. So making people aware is one thing, but actually building a product which suits their needs is another. So only time will say once we launch our cell culture products as to how well have our products been accepted by the market, by our customers in India and overseas.
Okay, fair enough. Thank you.
Thank you.
Our next question is from the line of Harsh from Marcellus. Please go ahead.
Hello, yeah. Hi, am I audible?
Yes, you are.
Yeah. So, Rohan, can you just give us an update on the inventory front? Like in 31st March, we had around 114 crores of inventory. What would that level be right now as on 30th June?
So, as on 30th June, our inventory is about to be 112 crores. It includes raw material of 36 crores, which has been reduced quite significantly in compared to the last quarter. Then we have work in progress of 13 crores, then we have finished goods of 45 crores, then we have the traded stock in trade of 8.5 crores, and we have packing material of 6.6 crores. Then other consumable and stores and spares are about to be 2 crores.
Okay. Yeah. Thank you, Santosh, for the detailed answer. And secondly, do you reckon that even we have to take any inventory write-offs because of this slowdown in demand? Because we also have a large inventory, and that inventory has an expiry date as well. So, I just wanted to get your views on that.
So generally, Harsh, the inventory for sterile items is about 3 to 5 years, depending on the quality of the manufacturing and the sterilization. But a very insignificant amount of inventory of ours is sterile. I would say more than 95% of our inventory is non-sterile, which generally holds good for a longer period than 3 to 5 years and can be sold easily. However, we have very limited inventory which is being built and there is no demand for it. Most of our inventory has been built based on our manufacturing structure of having to launch new products or having to build large batches of production.
Okay. Yeah, this helps. Thank you.
Thank you.
Thank you. Our next question is from the line of Omkar Kamtekar from Bonanza Portfolio. Please go ahead.
Hello, am I audible?
Yes, sir, please go ahead.
Yes.
So, sir, follow-up question with respect to raw material costs. Do you see any risk of a raw material cost increase? Is that a concern?
No, actually, we see raw material prices flattening out, to be honest. And the domestic non-branded raw material, which is non-medical grade, has been quite flat. The international raw material has also seen a very small increase or has been flat, but our purchase prices continue to increase as the euro has gone up and the dollar has gone up. So on an INR absolute term, we see an increase in raw material because of the depreciation of the currency. But on actual prices, raw material is very, very flat and under control over the last 4-5 months.
Okay, thank you. And with respect to the plant, just clarification with the previous question. So the Panchala plant and the Amta plant, the full commercialization, what was the timeline? I was not able to catch that properly. What was the timeline?
So it's two separate timelines because the Panchala and Amta plant are apart from each other. They are two separate plants, various kilometers away from each other.
Yes.
Pachla plant is completely ready. The infrastructure, everything, the clean rooms, it's just plug and play. The machines come in, you plug in and you start selling. So 100% the plant has been ready for the last 1.5 months, completely ready. And the Amta plant to come in the same position as the Pachla plant would take approximately another 4 to 5 months. By the end of December, we expect.
Okay. And the Pachla plant would be, what would be the capacity utilization when it starts, approximate capacity utilization? So because we can project what the revenue could be generated for one quarter, for the quarters.
So see, at this point of time, Pachla is going to be a mix of new products as well as capacity expansion. So I would not expect a lot of revenues from capacity expansion if it was to start today, because considering the industry trends. But with new products, we would expect revenues coming in. But however, the capacity expansion, by the time it comes in, would be the next 3 to 4 months. And if we see a recovery in the industry and growing demand, then it would work in our favor.
Okay. And what is the fixed asset turnover, so the gross block turnover that you target with respect to the overall, the overall capex that you incur?
So we expect our asset turn ratio. We expect our asset turn ratio on a gross block should be in the range of 0.65 to 0.7.
Yes. So do we intend to maintain this or going forward or increase it as further as we get? Or this is the norm for the industry?
We intend to maintain that. If industry goes in our favor, then it will improve further. But otherwise, we don't find any reason that it should go below 0.65.
Okay. So currently just to understand, the current fixed asset turnover would be 6.5, and we are wanting to maintain. If the opportunity comes, we can increase.
0.65, sir. 0.65, not 65.
Okay. 0.65. Got it.
0.65.
Yeah. Thank you. That's it. Thank you.
Thank you. A reminder to all participants that you may press star and 1 to ask a question. Our next question is from the line of Amar Maurya from Alpha Accurate Advisors. Please go ahead.
Hello. Hi. My question is, how do you expect...
Sir, may we request you to use your handset, please? You're not audible, sir.
Sure, one second. Hello.
Yes, sir. Please go ahead.
Hello.
Mr. Ahmad, you can go ahead, sir. You're audible now.
I'm sorry. Yeah. So, my question is, how do you expect PET and PETG products to contribute to your revenue, and how do you expect capacity utilization for those two products going forward?
So, at peak, based on our capacity, what we have put, we expect a revenue of approximately 35 to 40 crores at peak from the PET and PETG products. And most of these products are used in bioproduction and production lines. So, there's a process of validation by customers. It's not a general lab product used in a research laboratory by a biotech or a pharma company, but used more in production lines. So, we are seeing strong appreciation and demand for our products as we've launched these products over the last 2.5 months and continue to launch some sizes. So we see a good positive feedback, and we are hopeful on good revenue in the coming quarters from these product lines.
For the upcoming couple of quarters?
So we started receiving the orders from the customer for PDG bottles, and we expect that the market share will increase further. But we cannot anticipate what will be the exact numbers.
Apart from this, my second question is for stereological pipes, pipettes, which you are going to start. Has that started, and how do you expect that to contribute to the revenue?
It has started, but not in the scale where we can anticipate and expect global business. But we, no different to the other product lines, we've got a very positive response from the domestic market, and we have started revenues in small numbers for the serological pipettes from our pilot production, batch production.
Okay, and so my last question is, apart from stereological pipettes and the PET and PETG contribution going forward, what do you expect for the base revenue to grow apart from these two streams?
We expect from considering the industry gets back to normalized levels, we expect large revenue to come in from our existing product lines as we build strong capacities to be able to tackle on large projects internationally as well as in India, and cell culture products and bioprocess products which would be added in Panchla and Amta respectively, along with boosting of our equipment business as we bring in newer products from the equipment category. So it would be a three-way process: one, new products, one, the equipment, and one, our existing capacity expansions.
Okay, understood. Thank you.
Thank you. Our next question is from the line of Omkar Kamtekar from Bonanza Portfolio. Please go ahead, sir.
Thank you for the follow-up. So, sir, with respect to the new products that we are going to introduce from the Panchla product, the margin profile for these products would be in line with the current profile, or are they margin accretive?
No, it would be in line with the current products.
Okay. And with the Amta facility, we are also having a warehousing place there. So are we going to gain benefits with respect to some cost savings, and will that add into our margin positively?
We don't expect cost savings, but we expect operational efficiencies because we need a bigger place to be able to tackle revenues which are significantly higher than 300 crores at our current infrastructure setup. Beyond 300 crores is slightly difficult to handle. So we need a much more robust and better infrastructure to conduct a global business at a faster pace, at a faster scale.
Okay. So the Amta plant will be more of an operational efficiency bit.
Operational efficiency at about 80% of the plant area. 5 to 10% would be the Gamma plant, and another 10% would be manufacturing.
Okay. Got it. Thank you very much.
Thank you. Ladies and gentlemen, that was the last question of our question and answer session. I would now like to hand the conference over to the management for closing comments.
I take this opportunity to thank everyone for joining the call. We will keep updating the investor community on a regular basis for incremental updates on your company. I hope we have been able to address all your queries. For any further information, kindly get in touch with us or Strategic Growth Advisors, our investor relation advisors. Thank you once again.